The market snapped its two-week gaining streak. The Nifty and the Sensex are down just about 1%, but the mid-cap part of the market has held up rather well this week. Over the next 30 minutes, we will decode the week gone by on Dalal Street, tell you, of course, what the key events are that we need to track and watch out next week. And, of course, the IT space is going to be in sharp focus as earnings season kicks on. So we look at that. And FMCG is the biggest, hottest debate in the market right now. So we'll have Nimesh weigh in on this as well. I'm Surabhi Upadhyay, and you're watching the Editors Roundtable with me, Editors Nimesh, as well as Reema. Guys, thank God it's Friday.
Oh, yeah.
The market has had its fair share of news. But before we get started, we want to welcome in Anand Shah, CIO, PMS and AIF at ICICI Prudential AMC. Anand, you just made our Friday better. So good to see you in person in our office.
My pleasure.
Thank you for coming.
Absolutely, my pleasure.
So, guys, what do you make of the week?
Kind of a lull before the storm, I would say.
You are stealing my words, huh?
It was pretty much quiet. Pretty much quiet. We are not used to, right? We are not used to this kind of a market. So, no major block deals, no major news. Of course, Jane Street was a big news today, but otherwise, it's been even the Nifty, Bank Nifty has been pretty much range bound.
True.
I guess market is just waiting for some trigger to either go up or go down, right? There was nothing for this week. So I guess earnings will be a big trigger to watch out. We need to wait and watch as to what happens to the India-US trade deal. That will be a big trigger for a lot of sectors and stocks. So I guess lull before the storm. So let's hope it's turned out to be a better week next week. But yeah.
Ranged but resilient.
Ranged but resilient.
I think that's how we could just,
That's a good way of putting it. So let me quickly recap the week's numbers, and then we'll go forward. I mean, like Nimesh has been saying, completely agree with that. It does feel like this is a silence before the storm. Now, let's hope the storm turns out to be, optimistic and in favor of the bulls. But what we're talking about is a complete consolidation through the week. The Nifty being in all of a 250-point band. I mean, the trading range also wasn't very wild, so it wasn't a very choppy or volatile week. It's just a quiet week. The Nifty, by the end of it, ends down 0.7%. But the mid-cap index and the small-cap index, they've managed to do well. The action has been all about individual stocks. Just to give you very quick color, in terms of the movers and shakers, the ups and the downs, the gainers this week included the consumer durable space. There was a fair amount of defensive play in the market, so pharma and healthcare have done really well. The big news of the week, of course, was Apollo Hospitals with its mega restructuring. That stock is a Nifty winner this week. Then you've got PSU banks that have done okay. Defense was a good shining spot on Friday again, thanks to the big defense acquisition proposal being cleared once again. And IT is actually approaching its earnings in an optimistic way. The IT index is up 1%. What didn't work? Real estate is one, but financials have been uncanny. And across the board, look at the private bank space, look at the Nifty bank underperforming, look at the capital market stocks by Friday. They were also down quite a bit. So that's something to keep in note. Now, why are we saying that this is probably the silence before the storm? Because the market is running into some very, very important events. The first of them will be earnings, and we'll discuss that with our expert in just a bit. The second is going to be the shape and form of US tariffs, and of course the India-US trade deal. And the third is going to be the GST Council meeting, which could be far more than small tinkering here and there, and it's set for July. Quickly to sum it up, in terms of US headlines, and there's a lot to digest there as well. Now, what has the US president said? We know as of Friday that he said that letters will start going out to countries as soon as Friday itself. And he's saying that the final tariffs can range anywhere between 10% to 70%. And he's saying that countries will have to start paying these tariffs by the 1st of August. The critical question is, where will India be in this context? We know that we're negotiating a hard trade deal. There are still sticky areas like agriculture, like dairy. The key question is, can we, for instance, stitch a more favorable deal than Vietnam? Vietnam got 20%. Can we do better than that? It will suddenly make our export-oriented sectors and maybe stocks like textiles, etc., a lot more competitive. So plenty to digest. Completely concur with Nimesh. Enjoy the silence, a little calm before the storm begins.
Oh, absolutely. But let's ask Anand. You manage a lot of domestic money. What's your sense now? Is the easy money phase out of the way now, and it's going to be very much correlated to what the earnings is going to be for Indian markets?
Indeed, I think while it's all about this week, but let me give you 4 year and 4 month. Actually, since 2020, we had a very, very stupendous earnings growth rate. Profit to GDP moved from 2% to 4.7. So in a way, over a 4 year, we had 35% CAGR growth in the earnings. Now, that's not sustainable.
Okay.
And at this elevated levels of profit to GDP, we believe there's very little room for further profit to GDP to move up. To that extent, yes, we should expect 11 to 12%, which would be nominal GDP growth rate. That should be the overall earnings growth rate.
And that should be the market returns as well, you feel?
Yeah, in the long run, the market returns are, again, matching almost within a percentage points of the earnings growth rate, which is logical also.
But this is a safe answer. I mean, naya all-time high hoga ki nahi hoga? That's what people are really fixated on. Ki abhi kitna upar jayega by Diwali?
Few percentages of it.
So on that, I was again saying that this week, while it's boring, but I'm happy it's boring because sometime in February, we were looking at market down 18%.
Mid-cap is down 30-40%.
80% of small caps were down 30% from their all-time high. 60% of mid-caps were down 30%. So it was really, we've forgotten all that in 4 months.
That's true.
But we had a good 4 months. And within that also we had tariff, the Liberation Day, then we had Israel and India, Pakistan, and then obviously
Middle East.
The geopolitical risks, sharp hike in oil, all those things we have digested. So I think market's been fairly resilient in this.
So, Anand, just to set the context then for today's discussion, you want to quickly tell us your portfolio construct. What do you like? How is your portfolio shaped?
Yeah, so we were actually more overweight manufacturing, which was actually the reason why the corporate profit was fairly low from 2010 to 2020. And the background to that is actually we had a sustained pressure on pricing from China on most of the manufactured goods. As I say, from safety pin to boilers, from tires to tiles, whatever you would need, China would be happily supply you at a very cheap prices. So that was, and the corporate profitability was very low. On top of it, the banks, which is another big leg, there also we had asset quality reviews. So 2015 onward, we had a difficult times in banking also. Around September 19 is when we had a corporate tax rate cut, and then and since then we saw some revival in the profitability. So we were overweight manufacturing, we were overweight corporate banks, PSU banks, capital goods which were manufacturing aligned. That's played out beautifully over the last 4 years. We were underweight FMCG, IT, pharmaceuticals, more defensives which had done extremely well from 2010 to 2020. Over the last couple of years, we have added a few of the consumer services businesses. Telecom we always had. We have added airlines, diagnostics to some extent, or organized retailing. These are the areas where again the growth is a little better than the nominal GDP growth rate.
Okay. Organized retail brings me back to Trent. I know Anand is not going to answer specific stocks, but actually before we get to IT, which is the piece that Rima is doing, very quickly, since you mentioned organized retail, I mean, these are different companies, whether it's DMart, whether it's what Trent is doing, and the market gets used to high growth. So when Trent was delivering 50% growth, people were willing to pay top dollar. Even 90 times P didn't matter. Now Trent is saying 20-25%, and the market is in no mood to listen to it. So, what is your thesis when you talk organized retail?
So again, the growth, so I was telling Nimesh also that we have seen from the heydays of, when we're just at the infancy of modern trade, malls came through and the organized retail just took off. We have come a long way, all the way, and then we have success stories of DMarts and quick commerce more recently. So I think the key is it's a difficult business. It's a tough business, a low margin business. And to that extent, your debt needs to be under control. You need to be more equity funded. But more importantly, you need to have costs under control. So you need to survive. And you need to be making money on a very thin margins. And remain relevant for the customer value. You'll have to continuously offer value.
Absolutely.
That's some learnings over the last 10, 15 years where we've seen ups and downs in organized retailing. So I think that remains the key. Yes, growth sometimes are too good, sometimes. But I think in the long run, organized retail still will grow faster than the nominal GDP growth rate. As more and more people move from the traditional retail to more modern retail.
That's a long-term thesis that's still intact. More on consumer in just a bit, actually, with Nimesh. But Rima, IT sector, is it going to be a shubh start for earnings season?
Looks tough, right? But it starts on 10th of July, so that's the first date you need to keep in mind. The good news is that at least things haven't gotten worse compared to the March quarter. Yeah. So the situation hasn't deteriorated, but it's not gotten better. And these are the numbers. So usually the June quarter is a seasonally strong quarter. Q1 and Q2 is when IT companies typically deliver very strong numbers, but not this time because discretionary demand is still very much compressed. In fact, 4 out of the 5 Nifty large cap companies are likely to report a top-line degrowth. That's point number 1. Secondly, in terms of the full-year guidance, we're still looking at low single-digit revenue growth. Infy, according to our poll, might raise the lower end of its guidance from 0 to 3. We're looking at 1 to 1.5%. But again, we're talking about the lower end. If the upper end is raised, it's courtesy the acquisition. So again, nothing meaningful. And even for HCL Tech, analysts point out the lower end could be raised. But in a nutshell, what we're looking at is a low single-digit kind of a revenue growth. Here is where things are a little more exciting, and that's the mid-cap performance. As you can see, while large-cap IT companies are likely to report a top-line, degrowth, mid-cap IT companies, look at a Coforge on account of that SEBI deal. That's 6.5–7% kind of a constant currency revenue growth. Persistent has been persistently growing at 3 to 4%, and despite all the tumultuous times, it continues to deliver on that. Now, the question is, now let's stack up the stock price and the valuation. Now, at least this year, the Nifty IT index has trailed the Nifty. It's underperformed by nearly 17 to 18%. Valuations on a broader, if you look at it in a broad bucket, the Nifty IT is trading similar to its last 5-year average. So no aberration over there. But the mid-cap IT companies are trading at a 38% premium to the large-cap IT companies, according to research from Jefferies. But the question is, mid-cap IT companies have done very well. They've outperformed the large-cap peers, and valuations today are very expensive. So what does one do? Now, this is what the EPS growth is for the large-cap IT companies over FY25 to FY27. Basically, we're looking at a mid to high single-digit kind of EPS growth. But for the mid-caps, we're looking at a 20 to 30, 40% kind of an EPS growth, 40% for Coforge. So this is what justifies the premium valuation multiple that many of these mid-cap companies are enjoying. Anand, I know you said that, at least your bias has been more towards the manufacturing themes, the banks, etc., and less towards IT. But now looking ahead for the next 4 years, considering that they've gone through a period of price and time correction, do you think things can get better from them?
Indeed, I think the inefficiencies in the market are actually reduced in the sense what looked like an easy market in 2020, 2021 to pick something which was going to grow faster but was very cheap versus something which was very expensive and was expected. So we were very domestic oriented. Even today, our bias remains for the domestic economy because that's the more resilient part of the economy. I think as soon as you move out of India, you have all sorts of challenges. And US is among the largest customer for IT services, and you know what's happening there.
And there's AI, there's generative AI,
exactly.
which is changing the game completely.
So as it is your customer and the challenges in US and the rest of the world, which is growing much slower than India, poses a certain risk. But yes, you're right. AI is another uncertainty, or what it means. Whether it will be positive or negative, only time will tell. But I think the important point is what's in the price. I think the other challenge for us, and we've seen IT every now and then rallying 20%, 30%, but it's in the end has done nothing. So it does give that,
trading
risk,
rallies. Yeah,
trading rallies, because the valuations where they trade and the earnings growth rate that we are expecting from them, there's complete mismatch. And that's the key challenge that, if the growth, if they are ex-growth companies, they're not trading as an ex-growth companies. Let me put it.
So IT is in a wide, even mid-cap IT, where there is a little bit of growth.
No. So yeah, we are more bottom-up. We have a couple of mid-cap names here and there in our portfolios. But as a broadly speaking, we have never been able to get there yet to buy big way the IT in our portfolio.
Hard for, I guess, Anand to get excited when Rima puts those big numbers on the wall. It hits you. A company like Infosys is 1.5% to 3.5% growth.
I'll give you more numbers.
Oh, okay.
Like some levers and IT.
Oh
They
my
will
goodness,
surprise
yeah.
you.
We're looking at keeping growth expectations low. No, we've discussed IT, actually, the next big sector where actually there's a bigger debate now. And there is a bull camp and a bear camp at play together. That's the FMCG space. Is a turnaround coming, perhaps as soon as this quarter? We'll discuss this after the break.